President Trump is threatening tariffs on 8 NATO allies to force a deal on Greenland. Europe says it isn't for sale. So what happens when an immovable object meets an unpredictable force? Tit-for-tat counter-tariffs, an untested trade bazooka, or the nuclear option, leveraging $8 trillion in US assets?
Welcome to the world's most expensive game of chicken. And in today's dumb question of the week, can a Treasury auction fail? All right, let's get into it. So, Roman, last week I feel we tempted fate, didn't we? We did an Investing in Crazy Times episode and things just got crazier.
Yeah, who could have guessed that one? But look, I think that it's difficult for investors in this kind of environment because the news flow is pretty alarming. You've just got to look a little bit below the headlines to see how this could impact investment. And it could have a huge impact, certainly.
It's difficult for investors, but it's even more difficult for podcasters. So we've got to say, we're recording this on Tuesday, the 20th of January. Markets haven't opened yet, but it looks like there's going to be a bit of a fall. But how did we get here? So to just take a quick step back, a couple of days ago, President Trump announced 10% tariffs on 8 European countries. Obviously Denmark, which owns Greenland, but also the other countries which sent a few troops to the island. And these are meant to start on the 1st of February and then rise to 25% on the 1st of June, unless those countries agree to the complete and total purchase of Greenland. That's not going to happen, is it?
I'm not sure.
Oh, really? You think we could just capitulate?
Well, I mean, if it does come down to military force, clearly the US is going to be at an advantage.
But Denmark's not going to sell it to them. They're not going to be able to purchase it, are they?
No, I don't think they could actually purchase it. I think what will actually happen will be some kind of compromise. Maybe they'll rent some bases around the country rather than an outright purchase. And that way Trump can save face and Greenland gets some form of income over the long term, which would be in their benefit without having to give up sovereignty.
So you think that's where we might end up? But in the meantime, there's all this uncertainty where Trump's taking a hardline position that Greenland needs to be a US territory and is trying to make that happen through a trade war. Now, I guess the ball's in Europe's court. How are they going to respond? Do they have enough firepower in their financial arsenal to fight back?
I think they do. And I think primarily it's to do with the really large US tech companies and the trade imbalance in services coming from the US, particularly in tech. So if it were to hit the Mag 7 where it really hurt, which is their bottom line, then that could really screw up US equity markets because of their concentration. So Europe knows how to hit back. It's just a question of whether they can get their act together to actually put that through into the form of laws which they pass quickly enough.
I think that does seem to be the US's obvious Achilles heel, the tech sector. Now, there are a few ways Europe could potentially target that. The one it's been using up to now, sort of with a little wink, is regulatory enforcement, isn't it? Fines, antitrust cases, trying to force big tech companies onto a sort of more consumer-friendly footing. It hasn't explicitly been in relation to a trade war, but the US maybe views it in that way.
Certainly Trump views it that way. But I think it depends which of their options they use here. And there are two primary options, I'd say. The one which is most damaging is the anti-coercion instrument. They actually rustled this one up in order to counteract what had happened between China and Lithuania. But now that it's a ready tool, they can apply it fairly quickly by EU standards. But of course, we're still talking about a year from the point at which they decide to try and start it off to the point at which it's actually implemented.
Yeah, some people call it the trade bazooka. Like, it's on the books, it's legislation, but it's never been used. And I think when there's such an impactful legislative instrument that's never actually been activated, a lot of countries are going to be quite scared of pressing that button, except France. France is always willing to go up against the US.
Yeah, Macron has actually called for it to be used. And there are certain things about it which should make it faster to actually put into law. For example, it only requires a qualified majority, which means that 55% of the EU member states have to agree to it and 65% of the EU population. So it's a double majority rule. That's what they call it. But what it does mean is that one country can't block the entire process. There doesn't have to be complete unanimity.
Hungary, we're looking at you. But the process is not quite so simple. So as I understand it, the European Commission would have up to 4 months to assess whether coercion exists. Then there's this vote by qualified majority of the EU Council, like you say. Then there's a period of negotiation with the country which is supposedly putting the EU under pressure. And then, if those talks fail, the EU can deploy some countermeasures. Like you say, this process might take up to a year. But if we got to that stage, those countermeasures are no joke.
So let's just talk about the damage that ACI could do to the US. And of course, there's going to be blowback because it'll damage the EU as well. So it is a bit of a Pyrrhic victory, but it's about trading goods. So you could increase customs duties. You could have import or export restrictions. You could have quotas, licensing agreements. But the biggie, I think, is about services and investment. So here the US has got a big surplus with the EU, and this would be a really good leverage point for the EU against the US. So, for example, you can block foreign direct investment access to the EU. You could exclude goods, services, suppliers from public procurement tenders. So, for example, any kind of contract to do with European government. You could limit access to financial markets, which are, of course, very valuable in the EU. And, of course, it's going to affect things like intellectual property. So you could restrict protection and commercial exploitation of IP rights in Europe.
To me, that's the big one, that last one there, because those Mag 7 companies, they're built on ideas, really. And the fact that they have these patents and copyrights, which just allow them to exploit their services around the world and push down competition. If a territory suddenly says, you know what, we're going to ignore that and try and use your patents to build domestic winners, it could potentially just kill their margins overnight, even if you didn't exclude the US tech companies from Europe.
And that's where the concentration in the Mag 7 is really going to hurt America because it makes it an easy target. Now, Trump at the moment still has pretty good support amongst the US population, but I think if we did see a huge fall in the US equity market, which is what would happen if there was a huge drag on the Mag 7's earnings, well, in that case, I don't think the support would be there for Trump.
You said it's an easy target. I'm not sure how easy a target it is because Europe is so reliant on those tech services. Yeah, you could probably build domestic replacements, but that wouldn't happen immediately. And imagine how the US might respond. What if they bricked everyone's iPhones in Europe? Like if it got really bad and really antagonistic, we're very reliant on the US for tech.
Yeah, and this is why I say it's a Pyrrhic victory. I think we could impact their earnings negatively. But the effect on our economy, and here when I say our, I mean we're part of Europe, I think the effect on our economy would also be hugely negative. And nobody wins this war, right? That's the whole point of tariffs, which is that there are very few winners.
It's not just the effect on our economy, though. We're reliant on their tech for our daily lives. We're reliant on a lot of their defense companies for arming our militaries. Yeah, we can hurt their bottom line, but they can take away our guns and phones, right? So it's a difficult one to win. But anyway, this whole anti-coercion instrument, as we say, France is pushing for it to be threatened right now. Germany's kind of on the fence. Italy's saying, well, hang on, let's try and negotiate with Trump. How likely do you think it is that we would see this? Or is this one of those things where the threat of it alone is big enough?
I think that's what it's designed to be, a threat which is never used. Kind of like a nuclear deterrent. You just have it there as a threat. If you ever end up using it, you've effectively lost already.
But I think Europe's glad it's on the books right now because you can't deny that Denmark is being coerced.
Oh yeah, this is the textbook use of an anti-coercion instrument. This is clear use of trade to coerce a sovereign nation to do what it doesn't want to do, which is to give up sovereign territory.
And I suppose the reason Europe needs this instrument is because tariffing the trade in goods, which is typically what trade wars are about, is not enough for Europe. Europe sells more goods to the US than it imports. If it doesn't expand it to services, then the US has a big advantage.
You can just imagine people in Germany are just seeing this as a catastrophe because a lot of their exports are cars, luxury cars, and a lot of those go to the US. But look, this isn't the only weapon in the European arsenal. This is the kind of nuclear option, and there is an option before this which is much more likely to be used, I think. So if you cast your mind back to Liberation Day and the horrendous effects that would have had on Europe if it had gone ahead as planned, there were lots of emergency negotiations, and in the end, the EU prepared these retaliatory tariffs worth 93 billion euros. And of course, that was frozen after a trade deal was reached in July, possibly because of it, but it'll only stay frozen if the EU votes to keep it frozen. Almost like a dead man's trigger.
But we should remember that that trade deal that was agreed between the US and Europe last year was asymmetrical. So it involved a 15% tariff on EU goods and no tariffs on American goods. Do you think Europe made a tactical mistake there? They felt they were pressured into agreeing this deal, but it showed weakness.
Oh, no question. If there's asymmetry, it does show weakness. But they had this deal ready just in case they needed to retaliate. So that forced the Americans to the table, and it forced them to concede at least some of those tariffs.
But while there's this threat over Greenland, the European Parliament is presumably not going to ratify this trade deal, which means that as of February, these 93 billion euros of tariffs are going to come in. And we could get into a tit-for-tat escalation quite easily, I imagine.
I have to believe that the US is still rational. I still believe that they are a rational actor at this point.
What? Are you serious?
Yes. Simply because if there is a huge, obvious negative impact on the US, then clearly the US is going to have to act in order to mitigate that. And a huge retaliation is just going to affect everybody negatively. So I think at a certain point, rationality will return. I just don't think there'll be the support of the US when it comes to having this huge trade war escalate even further. Because this is exactly what happened after the Great Depression. There were huge escalations in these tit-for-tat tariffs, and eventually it massively damaged the US. And I'm sure that the US's historians will be busily reminding people, this is what happened before. Let's not do that again.
But Romin, the people back then, in the era of the Great Depression, were rational actors too. These things can happen. And I'm not so convinced that rationality wins the day in the White House here. I think there needs to be pressure from US business and US institutions to get them back on the rails.
But there would be pressure, I think, in the form of the market reaction and the effect on the Treasury market and the effect on the equity market. I think that's the main transmission mechanism to the White House at the moment. And I think there would be very clear negative effects.
I don't think these tariffs, these counter-tariffs, would be enough to change the White House's mind. So I've seen some estimates that it could add, 10 basis points to US inflation. That's not enough to move the needle. I don't think it's enough to completely tank the stock market unless the stock market thought it was going to get worse and worse.
Yeah, I think the ACI is the bazooka here. I think that's the big weapon which is just going to be used as a threat, because that's the one that affects the Mag 7. So the 93 billion in tariffs were targeted for things which would be politically sensitive rather than economically sensitive. So things like aerospace, the automotive industry, metals and metal-containing goods, things like bourbon, because lots of Republicans are in districts where lots of bourbon's made.
It's so weird, isn't it? Alcohol always comes up. Like earlier today, I think Trump said we're going to put 200% tariffs on French champagne. Like this is always the politically sensitive things. But I think it's clear that the EU's strategy broadly is to target politically sensitive areas, especially in Republican states, which might put internal pressure on Trump. But I kind of worry that the EU thinks it can bring a scalpel to a knife fight. And maybe not even a knife fight, like Trump's got a gun in the back pocket. But we shouldn't lose sight of the fact that the relationship between the US and the EU is the biggest economic relationship in the world. So the combined trade in goods and services last year was over 1.6 trillion euros. And to break that down, the EU ran a surplus of almost 200 billion euros in goods trade and a deficit of around 90 billion in services. So while the trade war focuses on goods, you'd have to think the US has a bit of an advantage there.
In goods, yeah. And that's why having the ACI as a follow-up blow, I think, is a very effective weapon, because that would hit the US square between the eyes when it comes to the effect on their stock market, which is, I think, the pain point for the White House.
The big question I think a lot of people are asking is, will this fight stay restricted to trade, or will it turn into a capital fight? I've read countless articles just pointing out the fact that European countries hold something like $8 trillion worth of US bonds and equities. It's the biggest creditor of the US, if you combine all the European countries. And there's always this thought in people's mind that, well, couldn't we just sell those treasuries? Wouldn't that solve the problem and pressure them so much that they have to just do what we say? I get the feeling it's not that simple.
Yeah, there was this article by George Saravelos from Deutsche Bank. He's their chief FX strategist. And he said, Europe owns Greenland. It also owns a lot of treasuries.
About 3 trillion of US treasuries.
And he says it relies on others to pay its bills via large external deficits, which is true. And the biggest lender to the US is Europe. So I think that 8 trillion in US bonds and equities is pretty chunky compared to the rest of the world. But the question is, how would Europe pull the plug on it? I don't think it could very easily.
This was the thing people always worried about with China, wasn't it? There was a lot of media attention paid to the fact that China owned a lot of US treasuries. It's since reduced that quite a lot. But at the time, you could have said it was the biggest single owner of US debt. And people were worried that, well, it could crash the treasury market if it suddenly sold all its bonds. But I guess you have to consider a few things. Firstly, if you own a load of treasuries and you want to sell them all at once, well, you've got to find a buyer for that debt. And secondly, what you're doing implicitly is crashing the price of an asset which you own a lot of.
Yeah, it wouldn't be a smart move. But again, all of these victories are Pyrrhic victories and probably an empty threat. Even if Europe threatened to do this, it would be a kind of stupid thing to do.
Yeah, but we're living in a stupid world. Is it even possible, though?
Yeah, I mean, there are various ways you could do it. I think the best way to do it would probably be gradual, and it could be based on legislation about risk weightings. So if you hold certain types of instrument, if you're an insurance company, a bank, then those have zero risk weightings, and those would generally be government bonds. And it effectively means you don't have to hold cash reserves, which earn even less. So one really subtle way to do this would be to say that, okay, US treasuries have a very low risk weighting right now, or maybe zero risk weighting. We're going to gradually ramp that up over time so that insurance companies and banks could no longer hold that so easily as a form of regulatory capital. Now, the effect of that would be to push up US debt costs. And of course, the US has a mountain of debt and a big deficit. So again, this is an Achilles heel of the US economy right now.
The US does have the dreaded twin deficit. It imports far more than it exports, and it spends far more than it brings in taxes.
And for the US, that's been okay.
Yeah, but these things could change. But I think the point you were making about the risk weighting is interesting because it hints at the fact that a lot of the commentary around all these treasuries that Europe holds sort of assumes that we could just push a button and sell them. But in large part, they're not held by governments, other than Norway's sovereign wealth fund. Most of it's just, on the balance sheets of private institutions and individual investors. It's much harder to force us all to sell our treasuries in some sort of financial last stand.
There's data which is published by the Department of the Treasury in the US. It's called the Treasury International Capital System. It's the TICS data. And I was just looking at the breakdown by country of the amount of treasuries held. Now, we've often talked about China cutting its holdings of US treasuries, which is quite a noticeable trend. But at the same time, other countries have massively increased their holdings. And I wonder if you can guess, Michael, who one of those countries might be.
Well, I haven't looked at the data. I know that Belgium holds a lot because of Euroclear. Cayman Islands has a bit. UK, actually, I think we have quite a lot.
Yep, UK has just gone up to just under $1 trillion, so 890 billion, and that's up from far less than half $1 trillion in 2020. So we've really ramped up our holdings. Luxembourg too, about half $1 trillion, up from about a third of $1 trillion or even less. That's over the last 5 years. France has massively increased its holdings to around 380 billion, up from around 120 billion. So while China's been selling its US treasuries, these European countries have been piling into that debt. But look, this would be held in things like a Vanguard Global Bond Fund. That's going to have a big chunk of treasuries in it. Or it could just be a straight US Treasury fund, which is held by some investors. So you couldn't turn around and say to people, well, actually, you can't hold these anymore. Or if you did, it would have to be an actual law that said we're going to prohibit any investments with more than X% US treasuries in it, which is just not going to happen. I can't believe that will happen.
Maybe the market will move in that direction a little bit, just on its own, though. Clearly, US treasuries are not as safe as they once were because the US is acting against the interests of, the rest of the world. I saw that Danish pension funds have already started selling down US treasuries. I think they sold something like 10 billion kroners worth last year. No, it's no surprise why Danish funds might be the first to move. But the Sell America trade could come back.
Well, I was shocked because Dan Iverson, who's chief investment officer at PIMCO, the massive bond investment company from the west coast of the US, they manage $2.2 trillion of investment money. He said that they're diversifying its portfolios. And that's a direct result of the US president's rapidly changing policies. So to quote him, he said, it's important to appreciate that this is an administration that's quite unpredictable, Iverson said. What are we going to do about that? We're diversifying. We do think we're in a multi-year period of some diversification away from US assets. And that's PIMCO.
Yeah, that's a US asset manager.
That's right. It's very brave of him to say that.
Yeah, I was thinking, why is he saying that out loud? Just do it. I'm going to stay quiet about it. But I think everyone who watches markets seriously must be thinking about, do I have too much US exposure, both in equities and bonds? It's the obvious question to ask right now.
I have this conversation so often in one-to-ones with people where they say, look, I've looked at what's happening in the United States and I feel as if there's too much exposure there. These policies are crazy and I'm going to reduce my exposure. And I'm always trying to talk people down from that. I'm always trying to say, look, the US is large for a reason. It's been very successful. They've got large, deep capital markets, and they're probably going to win this war. So I think there are lots of reasons why you'd probably want to keep your US exposure and not diversify away hugely. Maybe if you want to tilt, do it a bit, but not a lot.
It also might be a mistake to think that were this to get worse, that the US is going to be the only one impacted, or even the worst impacted market. Maybe we should think through those different levels of response from Europe and what that could mean for assets. We haven't got a crystal ball, we don't know, but let's have a think. Let's start with the relatively low impact option that seems almost inevitable to happen now, which is these retaliatory tariffs on goods. What assets would you be nervous about as a direct result of a tariff war?
Well, if we stick to goods for now, because this isn't about impacting services yet, then probably it would be things like automobiles and obviously high quality machinery, pharmaceuticals. They generate a lot of revenue for European companies. And if they impose tariffs on them when they're imported to the United States, then clearly that's going to have a negative impact. And then if you are a US company that relies on those imports, again, it's going to be an issue. And also things like luxury goods, fashion coming out of Milan, for example, that's going to be negatively impacted too.
The immediate reaction in stock markets usually seems to be sell car manufacturers, sell luxury good manufacturers. But there's also the question of what happens in the FX markets. Typically, the assumption would have been a trade war strengthens the dollar, but that didn't happen last year.
Yeah, and when we looked at what happened with the April sell-off, when we got the Trump tariffs announced initially, the dollar didn't rally. That was the shocking thing. That was the most shocking thing, I think, about the whole episode. Of course, equity markets sold off, but the dollar didn't rally. And we've also seen the dollar weaken over the last week or so with these announcements about Greenland, which again is, I think, quite telling. If people were scared, and if the dollar was seen as a safe haven asset in this crisis, it would have rallied, but we saw the opposite.
So for UK or European investors who hold US assets, the dollar weakening reduces the value of those things.
Yeah. And if we look at the market impact over the last week, well, the US has not rallied. In fact, if you look over the last week, and again, we're making this on January the 20th, what we've seen is that almost every country other than the US has rallied more than the S&P 500. So that's pretty telling also, I think.
Now let's imagine the standoff goes up a level and we get the EU implementing the anti-coercion instrument, targeting US services companies, maybe suspending IP rights, limiting the access of US banks and institutions to European capital markets, all of that stuff, which sounds extreme and unprecedented. Do we know what the impact of that would be? Is it just a big question mark?
A question mark, definitely. But risky assets would clearly suffer. I mean, that would be a huge blow to global corporate earnings because, to first order, the US is the global corporate earnings market. That's what generates most of the revenue on the planet. And if you knock that market and reduce its profits, well, that's going to pull the rug under risk assets globally. So I think we'd see equity markets globally sell off, with the US being definitely affected, Europe definitely being affected. Japan, I think, would be a safe haven to some extent, but that, of course, relies on exports to Europe and to the US. China also depends on exports to the US, and if there was a weakening of the US economy, then we would see that suffer too. So there would not be any winners in this kind of conflict. Maybe the safe things would rally. So, for example, gilts would be okay, I suspect. They'd probably rally. German government bonds would rally. Although there would be a question about the German economy at that point. But of course, that's when government bonds tend to do reasonably well. Gold, of course, would do well. And that's also been recently doing well because of what's going on in Greenland. So I'd expect to see that, but in even more of an extreme move upwards. But this is not a world we want to be in.
No. And to just talk about the final layer of escalation, if we got into a situation where Europe decided to dump as much of its US assets as possible, I guess everything you just said, but times 10.
It would be atrocious. But look, I don't think we're going to get there. I just don't think there would be the ability on Trump's part to maintain that kind of trade war.
I suppose the question that we're trying to answer in this episode, it's in the title, is does Europe have the financial firepower to stand up to Trump? Maybe, but it'll be kind of self-defeating. It's like mutually assured destruction in a way, isn't it? To me, the likely way that Trump is made to back off probably comes internally in the US. Maybe it's the Supreme Court ruling the tariffs are illegal, at least how they've currently been justified. Maybe it's a kind of revolt from Congress where even Republican senators and congressmen and women say, enough's enough. We can't be invading NATO allies. It seems like there should be a line in the sand to be drawn somewhere. Or maybe it's, the public just says enough's enough and the midterms go against the administration and weaken their power.
I think once it starts to affect Main Street in the United States, that's when it's going to be a problem for Trump. If it becomes obvious that your quality of life is now worse than it was when he came to power, well, you can't pretend. You can't gaslight people into thinking, oh, I'm better off now. Well, actually, I'm unemployed and I can't get a lot of the goods and services which I could previously at a reasonable price. You can't gaslight that.
Do you think Americans are more likely to kick off than Europeans? Because I guess Europeans will say this situation was forced upon us. It's not like we've been used to growing economies anyway. Whereas the Americans will probably feel, why are we doing this?
Yeah, I think their tolerance for discomfort and a lack of luxury is very low. So I think the minute it starts to affect their quality of life, there's going to be a big pushback.
From an investor point of view, I guess the one thing I would be looking for in the scenario where the US and Europe start to slowly uncouple is that if US tech is going to be slowly pushed out of the continent, who's going to step up? If there's a kind of enforced substitution, that would be an opportunity in the long term. In the short term, I don't think many equities will do well.
Yeah, I think if there are alternatives, and increasingly we are seeing those come in the form of software as well from China, then I think there could be a whole realignment of the political landscape globally. The US will no longer be seen as the default ally, and suddenly China will look much more attractive. It's already the case that the UK is kind of moving that way. If you look at imports of cars, for example, we're not imposing tariffs on Chinese cars, and we're importing quite a few of them now and likely to import a lot more.
But do we want to jump out of the frying pan and into the fire? I was hoping more for sort of European companies to step up.
Yeah, that would be nice if it were possible. But I think if we look at the sheer scale of innovation coming out of China, both in terms of intellectual property, in terms of software, I think it's going to be very difficult for Europe to compete there.
But what's your base case here? Is it what you said at the start, where you think there'll be some sort of fudge around Greenland and then we can all sort of get back a bit more to normal? Maybe that trade deal between the US and Europe gets passed and we just try and get through the next 3 years?
Yeah, I think normal is difficult to define here because I don't think we're going to go back to where we were. I don't think anyone feels now that they can trust the US like they used to be able to do. And I think Trump is a symptom of that. I don't think he's the only instance of that philosophy. I think he's quite likely to be replaced by someone who's more in line with him and less in line with the Ancien Regime, which was closely politically allied with Europe. So I think in this particular instance, yeah, there will be a backing off, there will be some kind of compromise deal which is reached. That's what I think is most likely. But longer term, what I think this has done is to erode institutions like NATO and to erode institutions like the US. and it's certainly put paid to the idea of US exceptionalism. I think this is much less likely now to be a country which is going to massively outperform in capital markets in future, simply because people don't feel safe allocating capital to a country where decisions are made on the basis of a whim.
Yeah, I think I agree with all that. I kind of agree that the base case is a muddling through, but I certainly don't rule out the fact that this could quite easily go very, very wrong.
If you like the way this podcast mixes a bit of humour with serious macroeconomic information and also discussion of markets, then why not sign up to our free weekly market roundup? You can find out more by going to our website, PensionCraft.com/newsletter.
Okay, today's dumb question of the week. Can a Treasury auction fail?
Okay, let's begin with what we mean by a Treasury auction. The idea is that the US needs money. They need to plug the difference between spending and what they raise in taxes, and they do that with debt. So they issue debt of various maturities and they announce an auction. So they say we're going to be auctioning this amount of 5-year treasuries on this date. And then the auction day comes up, people put in bids, and usually institutional investors are the ones bidding, but there are some retail investors that do it too. And then the auction goes through. So let's say they're placing $1 billion. There are maybe $2 billion in bids, and then we've got a 2-to-1 bid to cover ratio, and everything's fine. The bond gets issued, people buy it, and everyone's happy.
Yeah. But what happens if there aren't enough bids then to sell all of this debt? Is that what people mean by a failed auction?
Yeah, that's exactly what they mean. And it simply is almost impossible for that to happen, for the bid to cover ratio to be below 1.
Why, though? What if people just don't want US debt anymore for whatever reason?
The thing you've got to realise is that it's not the individual investors or institutions who are buying those treasuries directly. There are around 20 different primary dealers who deal in this market for US treasuries. It is a kind of special situation. It's kind of cool to say, oh yeah, we're a primary dealer in US treasuries. Companies don't want to give up that cachet.
And what are these primary dealers then? They're the kind of buyer of last resort.
No, in the UK, we call them gilt-edge market makers or GEMMs, and they're the ones who actually buy the stuff and then they redistribute it to other people, institutional investors, retail investors. So in order for a true failure of one of these auctions to occur, all of the primary dealers would have to simultaneously say, look, we're not going to buy these things. We refuse. At the same time, the Federal Reserve would have to abandon its enforcement of those dealer agreements because they're the ones that force these dealers to do their job, which is to place these treasuries. And then the final defense mechanism is that the government has to tell the Federal Reserve to purchase any unsold securities. So they'd have to not do that. They wouldn't direct them to do that in order for the auction to fail.
So I suppose we can't get a truly failed auction then, where the US is just going, oh, how can we pay the bills? We can't sell our debt. But you can get like really soft auctions where there's a really low bid to cover ratio. You get these big tails where the yield is higher than expected. That would indicate authentic demand is weak.
Yeah, there's this kind of grey market called when-issued trading. And the idea is that you can actually trade these things without settlement before the auction happens. So you can put in a punt for a yield of a certain amount. And often what happens is that grey market turns into the actual yield which you get when the auction happens. So it gives you a really good lead on how much demand there's going to be for a certain issue. So the government could always pull the issue if it realises in the when-issued trading market that it's not going to be a very popular auction.
There are weird legal situations where, okay, it might not fail, but they might postpone an auction. I know that in 2015, when there was a debt ceiling standoff, the US Treasury postponed a 2-year note auction because it basically sort of ran out of congressional authority and couldn't risk it not settling in time. The US is more likely to default just by stupidity than any sort of failure of market participants to turn up to an auction.
But look, I think the primary market, which is these bond issues, I think that's unlikely to be the pressure point. It's going to be the secondary market where you see yields spiking. And that's just as damaging because it means the cost of servicing debt when new bonds are issued is going to be much higher. Because when one of these bonds is issued, it picks up the yield to maturity from the existing bonds. So if the 5-year yield's 5%, chances are that the new issue will be something like that, maybe a little bit less.
And Donald Trump and Scott Bessent, the Treasury Secretary, seem to be really focused on the 10-year yield. That's one of the key metrics for them of are they doing a good job alongside the S&P 500 price.
Yeah, if that spikes, then it's going to be really expensive to service that huge mountain of debt which the US has now issued. Their debt to GDP ratio is 120%, and it's getting bigger because they're spending more than they're earning by around 5 or 6% of US GDP.
And it affects regular people, doesn't it? People who want mortgages, want to buy homes, want lower interest rates. Trump wants lower interest rates. If Europe and the international community slowly steps back from buying US debt, it's not going to help them get rates lower.
Yeah, if you look at the most damaging US market crashes, it's usually the ones where credit dries up, where there's the longest lasting damage. And in the case of Treasury yield spiking, well, if you buy a corporate bond, it's going to have that Treasury yield plus a bit layered on top, the credit spread. So a spiking yield curve is essentially throwing sand into the gears of the US economy. It depends on credit as its lifeblood. That's been the case for many, many years, over a century. So I think this is really critical to the US economy. And I think it's probably going to be the release valve that makes the US step back and say, look, we can't afford for this to carry on.
It was bond markets that did it last year, wasn't it?
When they went yippee, yeah.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.